Welcome to this workshop, Basics of Insurance. I am Janelle Cross. Life is full of risks, which in insurance terms is defined as potential for loss. We use insurance to avoid, reduce, or transfer the potential for loss. Of course, we can also choose to retain the risk by self-insuring. Just like we travel through the stages of financial wellness, our insurance needs follow a progression. In stage 1, our primary needs are establishing a foundation to insure loved ones and property. In stage 2, we might have more property to insure, but we might also need to increase coverage for things like paying for college or preserving investment assets. And finally, in stage 3, insurance is used to protect your retirement income, as part of an estate plan, or to execute a charitable giving program. The types of coverage most important in the financial safety stage are health, auto, homeowners or renters, and life insurance. The types of protection most important in the wealth accumulation stage are additional life insurance, disability insurance, and estate items like wills and trusts. The types of protection most important in the financial freedom stage are insurance for medical expenses like long-term care and supplemental life insurance, which can be part of an estate plan. Let's start with health insurance. Many folks obtain health insurance through employment. During an open enrollment, you can choose from a variety of options. Let's touch on a few that you might encounter. Let's start with HSAs, or health savings accounts. These are the save and spend later accounts, used to set aside money to cover your annual health insurance deductible. Next, flexible spending accounts, or FSAs. These are the use it or lose it accounts. You set aside dollars in your FSA that you can use tax-free throughout the year for things like medical expenses, but also for things like daycare costs. Health reimbursement accounts, or HRAs, are for medical expenses only. Think of these as the spend first and get reimbursed accounts. You'll usually need to submit proof of medical expenses in order to qualify for reimbursement. At age 65, you'll join Medicare. If you're still working, be sure to understand whether your employer requires you to apply for Medicare as your primary insurance, or if you can wait to apply until you retire. If you must apply for Medicare, note there is a window to apply. The window opens 90 days before your 65th birthday and closes 90 days after. If you fail to apply during that window, there are penalties, so be sure to stay on top of this task. When you do retire, consider meeting with an insurance specialist to evaluate your needs for insurance over and above Medicare. This type of coverage is called Medicare Supplement insurance. One additional note regarding HSAs. Most folks use these accounts to save dollars to spend on their annual deductible, but they are also a powerful wealth building tool. HSAs offer a rare opportunity to get a triple tax benefit. You take a deduction for your contributions, and the dollars grow tax deferred. When you take withdrawals for qualified expenses, they're tax-free. So if you can pay your medical expenses without tapping into your HSA, you can use the HSA as a supercharged investment account for healthcare expenses in retirement. Now let's talk about protecting stuff. Coverage for home and auto are collectively called property and casualty insurance. Coverage and costs vary widely, so consider working with an insurance agent. While some coverages like auto and homeowners are required by law, coverage for renters insurance is optional. That doesn't make it less important though. We do recommend acquiring this type of coverage, which protects your furniture, your valuables, and your other property. Another coverage we recommend is uninsured motorist coverage, which may or may not be included in your auto policy. And finally, umbrella liability insurance is worth considering if you're able to afford it. This insurance sits on top of your home and auto coverages and protects against injury and property loss experienced by other people on your property. Some folks need an umbrella policy more than others. Personal liability risk factors include owning or renting property, employing household staff, having a trampoline, a hot tub, or a swimming pool, or hosting large parties, for example. Also, having a teenage driver puts you at increased risk. Basically, the more likely you are to be sued, the more you should consider umbrella insurance. Here are some good P&C insurance habits to build. First, reevaluate your coverage every 2 to 3 years. As your needs and possessions change, your coverage should too. Check deductibles and make sure you are prepared to cover them if necessary. Consider uninsured motorist coverage and make sure your homeowner's insurance is replacement cost coverage. If you've visited their lumberyard recently, you probably know that it costs more to build a house now than it did when you moved in. Make sure your policy would provide what you'd need to rebuild. Okay, there's a lot to say about our next topic, life insurance, and many ways to use it within your financial plan, but a detailed discussion is beyond the scope of this session. So we'll focus on 2 general categories of life insurance. The first being term coverage, which you can think of as renting. You pay a set amount for a set time period. Although some policies contain an option to convert to permanent coverage, most of these policies will expire at the end of the term. Because these policies don't accumulate any cash value, this is the most affordable type of coverage. We recommend using term insurance to cover risks that have a finite life, for example, your mortgage or paying for kids to go to college. The other type is permanent coverage. There are many types of permanent life insurance, but most provide benefits for life so long as premiums are paid. Generally, the premium and insurance amount can be adjusted as your needs change. And many policies have cash value, which allows you to cancel the policy and take some cash with you. For this reason, these policies are generally more expensive than term. This coverage is used to protect risks that don't have an end date, for example, funeral costs or estate taxes. The most common question we're asked is, how much life insurance should I buy? As incomes and assets increase, you'll need more life insurance. A general rule of thumb for stage 1 is to have enough term insurance to provide loved ones with 3 times your annual salary, plus any significant debts you have. Now keep in mind that some student loans are forgiven at death. As you move into stage 2, consider adding some permanent insurance and increase your coverage to 5 to 10 times your salary. And as you enter stage 3, you may find you can decrease coverage as mortgages have been paid off and kids have flown the coop. However, sometimes insurance is part of an estate plan to restore assets lost to medical expenses, taxes, etc. And finally, maintaining life insurance throughout retirement is important if you do not have long-term care insurance. We'll talk about this a little bit more in a minute. You would probably agree that your income is one of your most important financial resources, but only about 1/3 of Americans have insured their income with disability insurance. As you enter the second wealth accumulation stage, protecting income takes on greater importance. A prolonged disability that leaves you unable to work can drain bank accounts, force early liquidation of investments, and financial stress can compound your illness and delay your return to work. This is why disability insurance is important. Like health insurance, disability coverage is often obtained through your employer, so understanding workplace benefits is critical. Equally critical is maintaining your emergency savings account, since most policies won't pay benefits right away. Most policies are layered, meaning one policy pays first, called short-term coverage, and a different policy pays if your disability continues. We call that long-term coverage. If you are unlikely to return to work for a very long time, you may qualify for Social Security disability insurance. While you may feel like Superman or Wonder Woman, the odds of experiencing a disability that results in lost income may be higher than you think. More than 25% of today's 20-year-olds will experience a disability before they retire. The average disability claim lasts almost 3 years, and the majority of initial Social Security disability claims are denied. Here are some good habits regarding disability insurance. First, know how long you'll have to wait before your coverage kicks in. This is where that emergency savings account comes in handy. Know your coverage period, in other words, how long benefits will be paid. And confirm whether benefit amounts are pre-tax or after tax. Now this depends on whether you or your employer are paying the premiums. And finally, confirm the definition of disability, which can be either own occupation or any occupation. Now this is an important but often overlooked item. Own occupation means you are considered disabled if you are unable to perform the duties of your own occupation. And this makes it easier to remain on disability when compared to the any occupation definition, which only pays benefits if you are unable to work in any occupation. Let me give an example to make that more clear. If you're a welder and can't weld, an own occupation policy would pay benefits. But if yours is an any occupation policy, they might want to be sure you can't sit behind a desk all day before they're willing to pay benefits. Okay, we're on the home stretch now, and speaking of homes, long-term care costs are a common destroyer of even the best laid retirement plans. Part of the reason is that we're living longer. Interesting to note that when the first Social Security check was issued in 1940, life expectancy for men was 61 and for women was 65. But the story is different today. The odds of a 65-year-old celebrating their 90th birthday are 35% for men and 46% for women. But that doesn't mean we're living in good health, thus the importance of long-term care planning. Absent planning for long-term care costs, family members are left to pick up the care burden. In fact, 1 in 5 are assisting with caregiving. Worse, 9 in 10 caregivers are receiving little to no financial support. So having a long-term care conversation is not only important for you, but for your aging parents as well. In fact, I have a client who purchased coverage for their parents simply to ease their own potential financial burden. You may have seen these scary figures before, but costs for care are steep and growing steeper. The yellow numbers represent the costs of care estimated by the year 2035. There are multiple long-term care insurance options, the riskiest being self-insuring, which means doing nothing. In this case, you're responsible for 100% of the costs. Many folks mistakenly believe that Medicare pays for long-term care. Medicare only covers very short stays and only under very specific circumstances. You may also have heard of Medicaid, a government healthcare program. Now, Medicaid is needs-based and reserved for those with very limited financial resources. Despite popular opinion, you cannot simply give your assets away to qualify. So that leaves us with insurance as the most common method of planning for long-term care expenses. There are traditional policies and policies called linked benefit. Linked benefit is actually a life insurance policy that will pay out early to cover qualified long-term care costs. It's also typically more affordable than traditional policies. Since most employers offer some or all of these coverages, a best next step is to make sure you understand the types and structure of your workplace coverages. Other key action steps are to review your insurance coverage every 1 to 3 years. As life changes, so does your need for coverage. Shop around to be sure you're making the most of dollars you're spending for insurance. Know how much you actually need. Consider completing a life insurance needs assessment. And apply before you need coverage. Many types of insurance that you purchase personally require a medical exam. So the younger and healthier you are, the lower your premium will be. And finally, if you can, pay your premiums annually. This will often save you a few dollars when compared to more frequent payment methods. Then, just keep taking the best next step. Google is full of advice, and so are family and friends, but not all advice matches your situation. We're here to help you figure out what the best next step is for you right now, so you wind up where you want to be. Align is here to help, so just reach out. Thanks for spending some time with me today.